this week, the attention turns to the Federal Reserve's two-day policy meeting set to conclude on Wednesday, while big tech earnings from Apple, Meta and Microsoft are expected to offer fresh insight into AI demand. Jameel Ahmad, Chief Analyst at GTC Dubai, joins us now for a look into the economic week ahead. Jameel, thanks so much for your time today. Big week both locally and globally, but we'll stick to the global picture and kick things off with the Fed. To cut or to hold? That is the question, Jameel. Which camp are you sitting in?
The Fed is very much stuck in the mud at the moment and is going to hold interest rate policy unchanged for a little bit longer. And there's a couple of different reasons why. As you pointed out, there is definitely let's say, a looming shadow in the room, which is going to be the Fed independence issue. We're expecting this to become a big headline throughout 2026. And that's even before we know who will be nominated to be the Fed chair. So until then, we're going to see Federal Reserve policymakers, specifically the voting members, be very cautious towards interest rate policy because, of course, public attention and pressure will be intensified should we get a pro-Trump nomination, which does appear likely to be the case. Otherwise, we're definitely going to be watching the ongoing US dollar weakness, and I think that also feeds into the Fed interest rate and the independence story, because you're seeing so much weaponization right now from the Trump administration, particularly when it comes to tariff and policy uncertainty. But there is a shining light from this. It feeds into emerging markets. You guys in South Africa are definitely enjoying some brighter days for the currency after many years of not seeing, I would say, bright skies. And even where I'm sitting right now in Hanoi, Vietnam, South Asian markets such as Indonesia, Malaysia and so forth are also enjoying this round of dollar weakness. And it does look like it can continue a little bit further.
It seems like emerging markets are in vogue. You look at currencies, you look at some of our equities. We also look at commodities in particular, and that really fueling the JSE with our gold counters and PGM counters also in the green today. Just on gold then, Jameel, and we can chat precious metals as a whole. That rally just doesn't seem to be stopping anytime soon. Does this speak to heightened levels of volatility?
Well, Valentine's Day is coming up in a couple of weeks, and investors continue to be romanticizing when it comes to precious metals, including gold and silver. Generally speaking, gold, $5,000 for the first time ever. It's not a big surprise, but it's still completely astonishing considering the assets now up 15% this year, somewhere like 80% over the past 18 months or so. And it's hit more than 50, I repeat, 50 new all-time highs in the past 1 year. I will put this down to investor diversification.
Okay.
We're definitely seeing some loss of investor confidence in the US dollar because of how erratic policy is when it comes to weaponizing trade tariffs. That might bite the US administration on the other hand, because obviously investor loss in confidence in the dollar is going to weaken their foreign policy appeal at some point, but that's certainly helping matters. And yes, we're all looking for where the gold bull basically is going to lose its charge. But generally speaking, it's still looking very optimistic. And for as long as that Trump administration continues to weaponize tariffs, and again, over the past week, you've had tariff threats on 8 European Union economies. You've also now seen over the weekend tariff threats on Canada, just for the reported rumor that because Canada's improving trade relations with China. And for as long as you get such uncertainty and erratic headlines, investors are going to continue to look at precious metals, and that includes gold, includes silver, and we're probably going to see some more diversification into emerging markets as well.
It's been very interesting to see how markets have been responding to all these tariff threats, considering that, towards the tail end of last year, most investors were, sticking with that taco trade. And that essentially played out yet again with those EU tariffs.
Yeah, I don't know what more to add to this matter, because I think we're definitely getting a bit fatigued from tariff headlines, but at the same point, it's like the storm that's not going away. I was actually being a little bit more optimistic at the end of last year that maybe we're going to start looking more towards traditional economics. But we look over what's happened the first 3 to 4 trading weeks of 2026. You've had that, shocking developments in Venezuela. You've also got, unfortunately, unrest that seems to be escalating in the Middle East. meaning more geopolitical conflicts are likely for this year, at least as a risk for investors. Now you've got the tariff threats continuing to be played like a house of cards. Of course, we're bluffing if you're talking about the Trump administration, but some damage will be done then because you've seen the US dollar has had its first largest fall since last year, just based on that threat. And then you're looking at increased market volatility. So yes, economic data is important, and we're definitely going to be watching economic data.
Yeah.
But generally speaking, what's driving markets is sentiment, and sentiment's been driven by very erratic headlines, where what we're talking about now might not actually be kind for tomorrow.
Yeah. Erratic headlines aside, let's look at what really matters, what really moves markets, where we have actual data and numbers. Tech earnings out this week, the likes of Meta, Microsoft, Apple, and Tesla out with numbers. Let's focus on the first two, Meta and Microsoft, Jameel. Expectations on that front, 2025 was a year where we saw these big tech counters spending billions on AI, and now there is an expectation that investors should start getting a return on investment. Is that going to come through in this quarter, or are we still going to see those hefty spending bills coming through? I think a week or two ago, we heard from TSMC also committing even more money when it comes to that AI spend.
I think we need to see wait some more time until we start to see that kind of investment pay off. We know that automation, over the longer term, is definitely going to increase profitability. But what I'm looking out for these earnings is that, firstly, we're still seeing that earnings in Wall Street continues to withstand global economic pressures and actually is beating expectations. However, the narrative is starting to turn a little bit more cautious, and I think that narrative might now start to turn towards more of a concern that the increased tariff rates and those tariffs being passed on to consumers is going to hurt margins. It's also a threat to profitability. And it wouldn't surprise me if we have a bit more of a cautious undertone to Wall Street and this current corporate earnings season. And again, because of all of the other, craziness that's happening in the world, we're not really watching it as closely as potentially we should. But I would keep a little bit of a close eye to see what Wall Street's saying about what the guidance will be for 2026.
You know what's been really interesting, Jameel, is the strength of the U.S. consumer, right? We all thought that we're going to see that tariff pressure come through. We thought it would play out in inflation. We thought it would hurt consumers' spending power. But that doesn't seem to be the case. We also saw those U.S. GDP figures last week for Q3 up 4.4%. Pretty strong, not showing any signs of stopping. We've got U.S. consumer confidence out this week. And with that due, talk to me about the health of the U.S. consumer and what's been keeping it so buoyant. I mean, even the banks, when the banks' earnings came out, we heard from some of the CEOs there pointing to a strong U.S. consumer. What's keeping that consumer so resilient? Also, when we have that jobs market that's also suffering.
Well, to be fair, it's actually that we've had years of full employment in the US, and we're starting to adapt now to a bit of a newer normal, where we're seeing US hiring start to stall. Of course, those numbers now for the non-farm payrolls, that's the monthly jobs reports for each month, are now starting to come in consistently below 100,000. But before then, you saw for many months, if not years, consecutive numbers of hundreds and hundreds of thousands of jobs being added to the US economy. That helps consumers because consumers are the biggest driver of spending in the United States, which is also the biggest contributor to US GDP. But what we are going to start watching out for when it comes to consumers is a little bit of concern about inflation fatigue. We're starting to see inflation come down on headline, but we're not really starting to see that feed into prices on the shelf. And should we start to see, again, a more aggressive trend of hiring freeze in the US, again, we're seeing consecutive numbers now of US economy only adding less than 100,000 jobs per month. Should that continue to stall, or we're actually starting to see layoffs? Again, we're not seeing a crisis yet for the US economy or the world economy as a whole. That does threaten US consumer confidence, but generally speaking, resilience in the confidence is definitely helping Wall Street, and it is helping those strong US GDP figures that you correctly pointed out.
Then over in the US, Europe, that is, GDP figures are due. Numbers out from Germany. Also looking at the region, we've got the Eurozone print also out. talk me through your expectations on that front. I mean, just looking at some of the PMI figures that have come through, pretty mixed. What do you think that economy is going to do? Are we likely to see some expansion coming through, and what could that mean for, I guess, the ECB's monetary policy moving forward? It does seem like we've come to a point where the ECB is on hold for now.
Yeah, starting with the ECB, the European Central Bank's definitely hit a wall when it comes to putting its head as far as it could towards cutting interest rates, because it was the most aggressive of the developed central banks. Generally speaking, we're expecting a little bit more of a better performance of the Eurozone economy for 2026. Growth is expected to be around 1.2%. Again, that's less than half what you're going to get in the United States.
Yeah.
But when you consider we've had years, if not a decade, of underwhelming GDP growth for the European Union, 1.2% at least an improvement. And we're going to start to see a little bit more, I would say, attention on improving Eurozone. But where the attention's not going to be so warranted, that's on the United Kingdom. Because the United Kingdom economy seems to be 2026, I would say, the economy that's going to be stuck behind, because that's where the advanced nations, that's the economy that seems to be lagging behind other advanced nations and its peers with GDP.
All right, let's leave it there, Jameel. Thank you so much for your time and taking us through the economic week ahead.